Are quant hedge funds better to work for than proprietary trading firms? This is a question many finance professionals grapple with as they consider their career paths. Both quant hedge funds and proprietary trading firms rely heavily on quantitative analysis, advanced technology, and data-driven strategies, but their work environments and career trajectories differ significantly. Understanding these differences is key to making the right choice. Quant hedge funds specialize in using mathematical models and vast datasets to develop long-term investment strategies. For example, firms like Two Sigma and Renaissance Technologies employ cutting-edge machine learning and statistical techniques to predict market movements and manage portfolios for institutional clients. These firms are structured and research-intensive, with employees working in specialized roles such as trading, research, and risk management. On the other hand, proprietary trading firms operate differently. For instance, companies like Jane Street, and DRW Trading focus on using their own capital to make short-term trades, aiming to capitalize on fleeting market opportunities. Prop firms thrive in fast-paced environments where agility and quick decision-making are critical. They emphasize individual performance and are heavily involved in high-frequency trading, where milliseconds can make a difference. Despite their differences, quant hedge funds and proprietary trading firms share some similarities. Both rely on cutting-edge technology, advanced algorithms, and top talent. Professionals in these fields often come from backgrounds in mathematics, computer science, or finance. Both types of firms also offer competitive compensation, making them highly attractive to skilled professionals. When it comes to work culture, the differences are pronounced. Quant hedge funds are more structured, with hierarchical teams and defined roles. For example, at Citadel, teams of researchers and portfolio managers work together to optimize long-term strategies, often involving multiple rounds of review and input from risk teams. This often translates to a project-oriented work style and longer hours, especially during critical periods of research and strategy development. In contrast, proprietary trading firms tend to have a flatter structure, which fosters quick decision-making in a more informal work environment. At firms like Jump Trading, traders may have direct access to senior management and are empowered to test and implement new strategies quickly. While prop traders may face intense workdays, their focus on short-term trades often allows for more flexible schedules once markets close. Compensation and benefits are crucial factors to consider when comparing these two environments. Hedge funds typically offer high base salaries, along with bonuses and profit-sharing opportunities. This provides a sense of financial stability. For instance, an entry-level quant at AQR Capital Management might receive a six-figure base salary, with bonuses tied to fund performance. Meanwhile, proprietary trading firms often feature lower base pay but include a profit split model that allows traders to earn significantly more based on their performance. At a firm like IMC Trading, successful traders can earn bonuses that exceed their base pay many times over, particularly in strong trading years. While hedge funds may include perks such as comprehensive benefits, relocation packages, and professional development programs, prop firms focus on rewarding entrepreneurial talent, sometimes even funding traders to develop their strategies. Both environments provide ample opportunities for learning and growth, but the focus areas differ. Quant hedge funds emphasize research, offering employees the chance to develop expertise in data science, portfolio management, and machine learning. For example, at Shaw, quants work on diverse projects such as portfolio optimization and factor modeling, gaining exposure to various financial instruments. On the other hand, proprietary trading firms are geared towards sharpening trading skills, improving risk management abilities, and fostering a knack for quick decision-making. At Tower Research Capital, traders are trained to respond to real-time market movements and develop execution strategies that can generate immediate profits. Career trajectories also differ. Hedge funds provide diverse paths that include management roles or transitions to other finance sectors, whereas prop firms concentrate on trading-focused growth or entrepreneurial opportunities. Risk tolerance and job stability are other critical considerations. Hedge funds tend to operate with lower risk levels since they focus on diversified, long-term strategies. This approach offers more job security for employees. For instance, at a firm like Man Group, diverse investment strategies across equities, fixed income, and alternatives help cushion against market downturns. Proprietary trading firms, however, embrace higher levels of risk, as their success depends on short-term market fluctuations. At Hudson River Trading, traders and algorithms often operate in volatile markets where large swings can lead to substantial profits or losses. While this can lead to higher rewards, it also means greater volatility in employment. The dynamics of teamwork and collaboration also vary between these environments. In hedge funds, teams often work together to develop and refine investment strategies, fostering a collaborative atmosphere. For example, at Point72, analysts and quants frequently collaborate to align research insights with trading execution. In contrast, proprietary trading firms place greater emphasis on individual performance. While mentorship and teamwork exist at firms like Virtue Financial, traders are largely expected to excel independently, creating a more competitive, high-stakes environment. Both types of firms rely on technology and innovation to stay competitive, but their focus areas differ. Quant Hedge Funds invest in sophisticated modeling tools and machine learning algorithms to analyze trends and manage portfolios effectively. At BlackRock's Aladdin platform, for instance, proprietary algorithms are used to manage risk and enhance portfolio efficiency. Proprietary trading firms, on the other hand, prioritize real-time execution systems, ensuring they can capitalize on market opportunities with speed and precision. At Susquehanna International Group, for example, traders and developers collaborate closely to create ultra-fast execution systems for optimal trading performance. For those considering job stability and career longevity, hedge funds are generally seen as more stable due to their diversified investment strategies. Proprietary trading firms, while potentially lucrative, often face higher turnover rates and are more sensitive to market changes. For instance, a hedge fund like Bridgewater Associates may continue to grow steadily even during market volatility, while a prop trading firm may shrink if certain strategies fail to perform. Choosing between these two options depends largely on personal preferences and career goals. Professionals who thrive in collaborative, research-heavy environments may find hedge funds more appealing. Meanwhile, those who prefer fast-paced, autonomous roles might lean toward proprietary trading. Before making a decision, it's essential to consider factors such as financial goals, work environment preferences, and long-term aspirations. Hedge funds offer stable salaries, structured career growth, and opportunities for diversification, while prop firms provide higher earning potential tied directly to performance and a more entrepreneurial work culture. Ultimately, the right choice depends on your individual skills, interests, and tolerance for risk. In conclusion, deciding between quant hedge funds and proprietary trading firms is a highly personal decision. Firms like Two Sigma or Citadel may appeal to those who enjoy structured research environments, while companies like DRW or Jump Trading are better suited for individuals seeking a fast-paced, entrepreneurial culture. Both offer unique advantages and challenges, making them suitable for different types of professionals. Take the time to evaluate your priorities, goals, and working style to determine which path aligns best with your ambitions.